WisdomTree is out with a brand new global corporate bond fund, the GLCB, that's the ticker. Here to tell us whether it's wise to own it is WisdomTree Chief Investment Strategist Luciano Siracusano. Luciano, tell me, why is this ETF better than the other ones out there?
Well, it's certainly a unique ETF in the sense that it's actively managed. It's the first global actively managed corporate bond ETF. And the fact that we're using Western Asset Manager, which is a institutional quality active manager, to run the portfolio, we think brings something unique to the table.
All right, it's global. So break it down. So where are these assets coming from? Which parts of the world?
Well, about 53% is U.S., but it has the ability to go outside the U.S. as well. So it also includes corporate bonds issued by developed world companies, as well as emerging market. So it's global in scope. It covers investment grade corporate debt as well as high yield debt, although right now the majority of the portfolio is investment grade. And it's debt that's denominated in dollars. And where it's not denominated in dollars, we hedge back the currency. So what we're trying to do is give investors a way to invest globally, don't take on currency risk, but take advantage of the fact that there's $11 trillion of corporate debt outstanding. Don't just narrow yourself and limit yourself to what's been issued in the United States.
And as I've said many times in my interviews here at the Street, investors want yield. What's the yield on your ETF now, and what do you think it's going to be at the end of the year?
Well, it hasn't made a distribution yet, so technically there is no yield, and I can't forecast it. That would be equivalent of trying to predict what the return is going to be. But when you look at the asset class and you look at what's out there in terms of global corporate bond indexes, I mean, you're seeing a little higher yield than you would see with investment grade corporates in the US. And part of that has to do with the fact that it does have some emerging market corporate exposure. So hopefully you could get yields that are a little bit higher than what you could see in the US investment grade spectrum right now.
And right now everyone's talking about a bond bubble when it comes to sovereign debt, to treasuries. But it doesn't seem like anyone's really afraid of corporate debt because there's a lot of cash sloshing around the system. And if companies need to get some more cash, they can borrow fairly easily. Do you think this is going to stick around for a while?
Well, the cash will be there for a while. The real question is what happens to interest rates and when do the central banks take their foot off the pedal? They've been putting it to the metal in terms of their easing. When rates back up, that's the risk to bondholders. So if you're in an ETF that's tracking an index fund, or an index, you may not have the nimbleness of a manager who's looking at different durations. One of the things that we like about an active manager in Western Asset Management, they can look at duration, manage duration risk. They can also manage the credit quality risk by doing individual selection on specific companies. And hopefully that can mitigate some of the risk, but if you're in a rising rate environment, things will change.
And I guess the big takeaway is right now, a lot of corporations out there are in better financial positions than a lot of governments out there.
That's true. The balance sheets for a lot of these companies is as strong as they've ever been. And that's one of the reasons you want to look at investment grade corporates around the world and some emerging market investment grade and even high yield bonds as well.
Something like the GLCB. Thanks for coming on, Luciano. Always a pleasure. And thank you for watching The Street.